Did you see the debt numbers on page 12? This is insane.
It is absolutely staggering. I mean, what we're fundamentally trying to do here is reconcile these just clashing orders of magnitude, the investment ambition for AI versus the reality of how you actually pay for it.
Okay, let's unpack this, because our mission for you is to figure out if this structural shift, which I see as the single most powerful economic mega force of our time, is a game changer.
A game changer.
Or if we're funding the world's most expensive bubble. I'm firmly in the camp that this shift from, capital light to capital intensive growth is the defining transformation. We'll see.
And I don't disagree on the ambition. The scope is.
Yeah.
It's huge. But let's look at those numbers you flagged. We're talking about $5 to $8 trillion in corporate capital spending on AI through 2030.
A massive chunk of the global economy.
It's like building a new industrialized nation from scratch. But here's the core conflict, the real timing mismatch.
Yeah.
All that spending, the CapEx, is front-loaded. You spend it now. The revenues that are supposed to justify it, they're way, way backloaded.
Right. And that gap requires financing. It means one thing, leverage. The report is pretty clear about the need to leverage up to get over this infrastructure hump.
Mm-hmm.
But the bull case, and I think this is important, is that the big AI builders, the hyperscalers, they're starting from a pretty healthy place. Their average debt to equity is only, 0.54x. They have room to borrow.
They have room to borrow, yes, but you have to ask where that borrowing is being piled. It's on top of already heavily indebted public sector balance sheets. I mean, U.S. government debt is at post-war highs.
So you're saying the private debt looks okay in a vacuum, but the whole system is more fragile.
Exactly. The public sector can't be the cushion anymore, so it forces the big question. Is the growth payoff even conceivably big enough to make this all worth the risk?
I think it is, and this is where the bull case gets really compelling for me. The AI spending is so large that the micro is the macro now. It actually influences the entire economy.
Okay, but for that $8 trillion investment to make sense, the U.S. has to do something it hasn't done in 150 years.
Break out of its 2% GDP growth trend.
Break out of that trend. And we have to really emphasize for you how rare that would be. Not steam power, not electricity, not even the first internet boom. None of them were able to fundamentally break that ceiling for a sustained period. It's a very, very tall order.
But AI is different, and here's the key insight from the report. AI has the potential to, and this is a great phrase, innovate the process of innovation.
Right.
It's not just about making things a bit faster, it's creating a self-reinforcing loop. The tools themselves start generating and testing new ideas, accelerating discovery, exponentially. If that happens, you could see a sustained 1.5% productivity boost.
Which would be, about 1.1 trillion in new economy-wide revenue annually?
Exactly. That macro math can justify the spending. It really can.
Okay, the macro math could add up. But then you have to look at the micro reality, which, is flashing red. U.S. stock valuations are just, they're incredibly stretched.
You're talking about the Shiller PE.
The Shiller PE, yes. The 10-year average. We are at the most expensive levels we've seen since the 1929 crash and the dot-com bubble. Bubbles, they only look obvious after they pop.
But were people not saying the same thing all through the 90s? That we were using old metrics for a new kind of technology? The argument is that the high valuations are justified by this unprecedented growth.
The difference, I think, is the revenue gap.
Yeah.
Even with really robust growth assumptions, the analysts are estimating, about 1.6 trillion in incremental revenue for the hyperscalers through 2030? That just falls way short.
It falls short of the revenue you'd need for a, say, 9 to 12% ROI on that $8 trillion figure.
Right. So the crucial question isn't just, does the economy benefit? Of course it will. The question is, do those specific revenues flow back to the companies footing the bill?
The AI builders.
The AI builders. There's a huge risk that the benefits just get diffused everywhere. Cheaper processes, new apps, and they don't get concentrated back with the platform providers. That uncertainty makes this a deeply active investment story. It's not a passive rising tide lifts all boats kind of thing. And that leads us straight to the physical limits. Because even if they solve the revenue problem, they slam right into a wall. The biggest constraint now, it isn't chips.
No, the report says the bottleneck is land and energy. That quote from the portfolio manager really stood out to me. He said, companies haven't struggled to get chips. The real constraint is land and energy.
And you can't just print a new power grid, can you?
Not at all.
To put this in perspective for you, AI data centers could eat up between 15 and 20% of current U.S. electricity demand by 2030. Some estimates go higher, maybe a quarter of current demand.
So that 20% number, that's like adding 3 new California's worth of power demand in just a few years.
That's for AI. And if those physical limits start to bite, if the grid can't handle it, then what happens?
Then the CapEx plans get walked back. The whole ambition gets crimped, and your valuation skepticism starts to look pretty smart. Strategically, though, that capital-intensive boost is likely to stick around into 2026. That supports overall growth, even with the labor market sort of cooling into this weird no hiring, no firing stasis.
Right.
And that continued investment should give the Fed more room to keep trimming rates in 2026.
But here's the catch, and it's a huge one that connects right back to the debt. Inflation could prove to be really sticky above the Fed's 2% target. If all that borrowing for the AI build-out keeps the cost of capital structurally higher, that could reignite all those policy tensions.
Which brings us to a very strong tactical call they make on fixed income. Because of the high debt servicing costs, they're pushing up the term premium.
And for you listening, the term premium it's just the extra compensation you demand for holding a long-term bond instead of a short-term one, for taking on all that future risk.
Exactly. And because that premium is rising, the BlackRock Investment Institute is explicitly underweight long-term treasuries.
And that's a critical insight for you to absorb, that decision.
Yeah.
It reflects a much deeper truth about today's market structure. We've established AI as the dominant driver.
A single mega force, yeah.
So an ever larger share of the S&P 500's returns comes from that single common driver. Market breadth is just shrinking. Fewer stocks are doing all the work.
And here's where the investment world needs a wake-up call. The portfolio decisions people are making under the guise of diversification, they're not really diversifying.
They're a mirage.
They are a mirage. You think you're spreading risk, but you're just making a big active bet against the main driver of the market.
And precisely. If you hold a market cap rated S&P 500, the biggest companies get the biggest weight. If you hold an equal weighted one.
Interrupting. And look at the data they found on that. The equal-weighted S&P was up, only 3% this year versus 11% for the market cap S&P.
It's a huge gap.
So what this means for you is that by trying to diversify into a broader index this year, you actually hurt your returns compared to just sticking with the biggest tech names. It's the exact opposite of what diversification is supposed to do.
And the reality is, if that AI theme stumbles, your traditional diversifiers have lost their punch. The biggest problem is the loss of portfolio ballast. Long-term treasuries aren't the hedge they used to be.
So people are looking at gold again, but the report is skeptical about that as a long-term hedge. It's tactical, not reliable ballast.
Right.
So what does this all mean? It means since passive diversification is struggling, the focus has to shift completely. We need truly idiosyncratic return sources.
Things that aren't correlated with the broad market.
Exactly, which points you towards private markets, hedge funds, places where manager skill and active selection are the only real differentiators left.
Which brings us to what some are calling the forbidden topic. With all this leverage, especially in non-traditional financing for these huge projects, is this just 2008 all over again, but hidden away in the opaque world of private credit?
It's a scary question. The report's analysis suggests that while private credit has hit an uneven phase, the stress is concentrated. It's not contagious.
For now,
you can see pockets of stress. Look at the data on dispersion. The covenant default rates among smaller borrowers under 10 million in EBITDA are way higher than their bigger blue chip counterparts.
So there's a widening gap between the disciplined, established lenders and some of the newer, more aggressive players.
And we're seeing dispersion by industry too. Businesses tied to the consumer, or ironically, businesses threatened by AI. They're the most at risk.
The hidden risk here is that the reported data can mask the stress through restructurings or payments in kind where they just add the interest back onto the loan. A shakeout is coming. It's necessary.
And here is the crucial warning, especially if you're an individual investor looking at this space. The flow of retail money into these semi-liquid private credit products, it's probably going to be pro-cyclical.
Meaning people chase the high yields on the way up.
And then panic and try to pull their money out all at once on the way down. Those redemptions could just amplify the volatility across the whole sector, turning what looked like a high-yield investment into a liquidity trap. Manager selection is everything here.
Right. Okay, so moving beyond that, let's touch on the other mega forces, because a lot of them loop right back to AI. Infrastructure, for one.
Indispensable. It's the picks and shovels. It provides the power and networks that the AI winners will rely on no matter who they turn out to be.
And there's a valuation opportunity there right now. Listed infrastructure is trading at a deep discount, even below GFC levels. That reflects rate uncertainty more than it does, bad fundamentals.
And private capital is going to be central. It's needed for the energy projects, securing land, water, power, the exact physical constraints we were just talking about. It's a defensive theme that actually benefits from the bottleneck.
Then there's geopolitics. The U.S.-China AI rivalry is now really the defining feature of geopolitics. It's about economic and military advantage.
And that's creating this urgency everywhere. You see NATO allies targeting 5% of GDP on defense by 2035. That's a huge jump from the old 2% target. It creates immediate opportunities in defense, tech, and even European utilities.
Shoring up critical infrastructure.
Then, shifting to emerging markets, the report says they're turning overweight hard currency EM debt.
Right, so debt issued in dollars or euros, less local currency risk.
And the reasoning is solid. Credit fundamentals are improving. You're seeing sovereign rating upgrades, especially in high yield. You get attractive carry, and there's not a lot of new issuance, which supports pricing. It's a compelling tactical call.
And strategically, long-term, they have a strong preference for Indian equities, demographics, digitization, geopolitical position. That's a very compelling story, separate from all the China volatility.
And really quickly, the future of finance. Stablecoins, now a $250 billion market, and they're becoming a bridge between traditional and digital finance. There's this regulatory act that could let them compete directly with bank deposits.
Which would be a structural threat to traditional lending if it scales.
Absolutely. So let's tie this all together. We have this core tension. The bull case is this massive AI investment unleashes a productivity breakout. The bear case is it's a bubble fueled by leverage with severe concentration risk and physical limits.
The takeaway for you is that passive strategies are struggling. In this two-speed market, active investing is really required.
And if we have to leave you with one specific tactical warning from this outlook, one asset class that they are explicitly underweight for 2026 is long U.S. Treasuries.
They just don't provide that traditional portfolio ballast anymore. The consensus is they're going to continue to be pressured by that rising term premium and, just the sheer cost of servicing all this government debt.
So, since traditional diversification is proving to be a mirage, here's a final thought for you to consider. If the AI energy crisis is the biggest bottleneck to this $8 trillion build-out, does that mean the real investment opportunity is less about the shiny tech companies and entirely about the unglamorous infrastructure companies that can actually solve these physical constraints?
Especially when the report notes that China has structural advantages in building power generation and transmission at a pace we can't match. That right there might be the real race of the next decade.